Hi, welcome to Common Sense Cafe. I'm Kevin. My brother Jeff is out. He's on vacation this week. I think they're down in Austin, Texas, and it's going to be over 100 degrees today down there. Yeah, so hopefully they'll just stay inside and spend some time in the swimming pool with the grandkids, and they'll have fun. So we'll see them next week. Today I'm going to cover the topic of credit scores and your credit report, and see if we give you a little bit of information that may can help you. There's been a couple changes that some of you may be interested in, and we'll see what we can do. So, to start off with your credit report or your credit score, you may have heard the term my FICO score, and what that means, the FICO is just an application that a company that has a financial software that calculates the credit scores. And this credit score that has been used for years and years, or the calculation has been FICO 8. Now, that doesn't mean much to you, but it's the 8th application of that FICO software, I guess it is, and they've used that version for years. Now there's a FICO 9 that's been out since 2014. Of course, it wasn't until 2016 that maybe some of the financial institutions are using it a lot more frequently, but and still it's not the most popular out there. So but I'm going to give you some information, and that way when you go into to ask for a loan, you ask your lender, do they pull a FICO 8 or a FICO 9? And I'll give you some reasons here that you may want to be aware of that. What's changed on the FICO 9 is that medical collections are less critical. You know, for years, so many people couldn't get a loan. Their credit score was low because of only one thing. They paid their bills on time. They're good borrowers, but they have had some kind of incident occurrence come up in their life, and they've had medical expenses that just was overwhelming. They couldn't pay right away. They paid as they could, and maybe have gotten behind here or there, or maybe the financial company or the medical company, the hospital or doctor, turned the bill over to a collection agency. Those have hurt our credit, or people that have used them have had medical issues. It's hurt their credit for a long time, and now the government has decided, or the credit bureaus have decided, that this is no longer the way we want to calculate credit scores. So the FICO 9 is a lot less crucial, or a lot less critical of the medical billings. So that if you got medical bills that may be hurting your credit, that may be something you want to be aware of. Also, paid collections. You know, you've had maybe something came up and you got behind on your credit for a while. You got behind on your bills, and maybe one of the bills was turned over to collection, and to a collection company, and you continue to pay it. You paid it until you paid that collection off. It's gone. But the old FICO 8, it stays on there for 3 to 7 years. Stays on your report, hurting your score, bringing it down. And with the FICO 9, no longer, they disregard it any longer. They disregard it now. So as soon as, or when you have a collection, a bill that's been turned over to the collection agency, and you paid that off, once you've paid it off, they disregard it. The third thing that has changed is the leasing companies, or the large these large apartment complexes. The commercial leasing companies can now report to the credit bureaus, and if they have a problem with you, if you've had problems paying your bill, it could hurt you and lower your score. If you paid on time and everything is well, it may help improve your credit report. So those are the things that have changed from the credit from the FICO 8 to the FICO 9. So you're going to be aware of that, and if you've had some of these issues, maybe you need to call before you take out a loan. Say you're going to buy a house or a car soon, and it may do you well if you've had some of these situations to call your bank or your credit union or who you're going to borrow money from and ask them to say, do you use the FICO 8 or do you use the FICO 9 score? And suggest that they do use the 9 if you've had these problems. Okay, well, let's look a little further. There's, did I cover? There's 3 credit bureaus that collect your information. When you take out a loan from a bank or a credit union or a charge card, your creditors report to one of the 3 or 2 of the 3 or 3 of the 3, all 3 of the credit bureau companies. And all they do is collect the information. And then the banks or the financial institutions that you're borrowing from, they use the FICO calculation to which FICO goes in, it pulls the information from the credit bureaus and then does the calculation and gives us a score. The bureaus are the ones that pull the information. If there's anything wrong or misstated on your credit bureau reports, you need to contact those bureaus and get them to correct it. So, with that said, you need to have some method of pulling your credit reports once a quarter. I use a company that watches my credit reports, notifies me when there's been activity. Once a quarter, they pull all 3 credit bureaus. I get a full report showing every detail that's on the credit bureau reports, which is you have Equifax, you have Experian, and you have TransUnion, and the credit bureau reports show who you owe, how much you owe, what your balance is, how much it originated, what was your high balance, what was your low balance, how long have you had that credit relationship, how well you've paid whether it was on time or delinquent. What else does it show? Just everything about that credit. Is it a termed out loan or is it an open-ended loan? Is it a revolving loan like a charge card or a home equity line of credit where you can borrow up to a certain amount and pay it down and borrow up again and pay it down and borrow without having to go back and forth to the institution to take out a new loan. So those are that explains that. Let me look and see what we need to look at. Okay, let's look at one thing you need to know. People say, well, why is my I use a company like maybe you use Credit Karma or Credit, and I'm not suggesting you do. I've heard good things and bad things about Credit Karma. I don't know. But you use one of the online companies to pull your credit and look at it and you say, well, why is my credit score different when I pull it online and then I go into the bank to get a loan and it's different? They say I have a different credit score. A couple things could happen. One is that when you pull a credit report and it calculates a score for you, that's a moment in time. So let's say on the 5th of the month you go in and you online and you pull your credit report because you know you're going to want to go look at cars tomorrow. You pull your credit report and it gives you a score, and then tomorrow you go in and that was on the 5th, and then let's say on the 6th one of your companies report that you were late on a payment. Well, it changes the score. So it matters as far as a point in time. It's only good for that one point in time. But in saying that, it shouldn't fluctuate much from the time you pull it to what the banks are pulling, and even if it's off a little bit, it shouldn't be off very much. Now, another thing that could cause it to be different is, like I said, you have 3 credit bureaus, Not every bank reports to all three bureaus. So if you have a credit relationship with the bank you took out a loan, maybe they only report to TransUnion, or maybe they only report to Equifax or Experian. If they do, then the other two companies won't have that information. And if you've had a good relationship with the bank, that you need all three bureaus to have that report, so that information, so to help improve your score. If you've had delinquencies, maybe it won't show up on these other two reports because the bank is not reporting to them. And then again, maybe some of your information is being reported to Equifax or Experian, and then the bank is pulling a TransUnion report when they calculate your score. And so you've got three bureaus, and it depends on which bureaus that your bank or financial institution reports to, your credit cards, and it depends on which credit bureau the bank or the financial institution uses when they pull to when you apply for a loan. So those are the things that cause the scores to be a little different. And I say a little different. There shouldn't be a lot of fluctuation there. Let's look at how is a credit score calculated, and I want to go through this rather speedily. It's number one is payment history. We know that the way we pay our credit, whether we're delinquent and that, or whether we're make payments on time, that can affect our credit report tremendously. And usually it's only if it's 30 days late, 60 days late, or 90 days late. If it's over those three amounts, it's reported. Under 30 days late, it's not reported to the credit bureau. But there again, you don't want to pay on the 29th day and the bank, we didn't post it to the 30th day, and then it dings your credit report. So you don't want to get to that point. But your payment history accounts for 35% of your credit score. And maybe you thought it accounted for a lot more than that, but it doesn't. It's 35% of your credit score. The number two thing is just as crucial with the 30%, and that is the amount you owe versus it's the revolving line of credit. It's how much you have available to borrow versus how much you have borrowed. So that's things like your credit cards and your home equity line of credit. They have a balance that you can borrow up to, and then it fluctuates as you pay it down and then borrow against it again and pay it down, just like a charge card. So those things affect 30% of your credit score. And what they look for is how much of that available credit have you borrowed. Let's say you have $50,000 with the home equity line of credit and 2 or 3 credit cards. You have $50,000 available credit that you can borrow. But you've borrowed up to 35,000. So you can borrow 50,000, but you've borrowed 35. That means you've got $15,000 left that you can borrow. But what that also means is that you've used, your utilization rate is 70% of your available lending power. So banks or financial institutions, they like to see it a lot lower than that. They want to see that you are have a 30-20% utilization of your available balances. It kind of goes back to, well, if you need to borrow money, you can't borrow money, but if you don't need to borrow money, you can. But honestly, what they're looking for is how well do you manage your financial relationships? Are you a disciplined person that doesn't go out and get a credit card, run it up to the max it out, and max it out, and another credit card, max it out, another credit card, max it out, a home equity line, and max it out? You do this and you say, well, I've got 3 credit cards and a line of credit, home equity line, and they're all maxed out, but I pay on time every month. I never missed a payment. Well, it's still hurting you. 30% of this score is based on you being able to manage your balances. If you maxed out on all your credit cards and your home equity line of credit, it shows that you have an appetite to spend. You're not self-disciplined to keep a balance there. So they're going to be less likely to loan you money. You're a higher risk. So keep those balances low. One question that people ask is, well, should I close my credit card when I pay it off? Well, there's 2 things to consider, and I say that depends. Should I close out my credit card when I pay it off? And that depends. It depends on how disciplined you are to take that credit card, put it in a drawer somewhere, put it away somewhere where you know where it's at, and use it for emergency only. Don't keep it out there. If you're disciplined enough to keep a 0 balance on it, then it may be best to keep that open. Number 1, for emergency spending if you had an emergency come up. Number 2, if you close it out, it decreases the amount of money you have available to borrow. So let's say if you closed out a $5,000 credit card, then now your borrowing power goes to $45,000, and if you still have a $35,000 balance out there, then you've not done yourself any good. But if you want to widen that gap between how much you can borrow and how much you have borrowed. Widen that gap to where you have a lot of availability to borrow. Another thing about that is that number 3 on the list of how they calculate your report is that 15% of your score is from the length of your credits. How long have you had a relationship with this bank or this credit card company? Or so? I've got a credit card that I've had, I don't know, 18, 20 years, something like that. So they can look, and they don't keep a record. They only go back supposedly 7 years on your credit bureau report, but it does state when that account was open. And if it was open 20 years ago, and I still have a financial relationship with them today, then it says that you have probably managed your financial affairs very well, and to be able to keep that financial relationship that long of time. Let's say you're fairly new to borrowing, and you go out and you borrow, you open a credit card and you borrow up, let's say it's $1,000, and you borrow $1,000, go out and charge and buy you those little toys or something that you wanted to buy as soon as you got your credit card, but you paid it down, and say that's over 6 months or a year, you open that credit card. It's really the only thing you have on your credit report, and you paid it down. You say, man, I'm doing good. I opened a credit card, I paid it down over time and never missed a payment, never late, and you have done good. I'm with you. But what the financial institutions say is you only have a 6 months or 1 year history of how well you manage your money. So they want to see a longer period of time that you've been able to manage your money and financial relationships over a longer period of time. So if you've got a credit card that you've had for quite a few years and you've paid it down to 0, well, if you can be disciplined and not use it, put it away somewhere. Don't close the account. Let it help improve your credit score. But you've got to be very disciplined with that. And I would also say, even though you have a 0 balance, go check your credit card statement every month. Make sure nothing's shown up that you didn't expect. Let's go on a little further. The 4th thing is new credit. Accounts for 10% of your credit score. So if you've had, let's say if you've opened up 3 new credit cards in the last 6 months, well, that's dinging your credit because 10% of your credit says, you shouldn't have new credit. If you're coming to borrow from us, it should be that you haven't borrowed from anyone else in quite a while, or for some, unless you can explain the reasoning behind it. You don't want to borrow credit, open a credit card, run the balance up, open a credit card, even if you don't even use them. If you open 3 or 4 credit cards, and then you come to a financial institution, you want to buy a car, and those other 3 credit cards that you opened up relatively short period of time, they lower your score because it just shows that you may not be disciplined in even applying for credit. Because now you've gone from having maybe 1 credit card with the $5,000 balance, available balance, to having 4 credit cards with $5,000 apiece. You've got $20,000 that you can borrow. So even if those balances are at 0, they've been opened up very recently, and if you borrow from, if you come in to apply for a loan at a financial institution, they're going to say, well, all of a sudden you've got $20,000 you could borrow up to, and you're wanting to borrow from us, and it will overload you, and you won't be able to manage all 4 loans, and so it could hurt you a little bit there. Types of credit card, types of credit. All I'll say about that is it used to hurt a lot when you had department store credit cards versus Visa or MasterCard. It really doesn't make that big of a difference now, but it just everybody needs a loan for a home. Everybody needs a loan, or mostly for a vehicle. So those kind of credits are well established, well expected credits that we would want to see on your credit report. Maybe a credit card or 2, but if you've got a credit card from each department store out there, from 5 different department stores, well, it says, well, you may have an appetite for spending that can get out of control from time to time, so it just makes you a little bit more risky. But again, the 2 most important things is how you pay your bills, and how you balance how you manage the balances on your spending. So pay attention to those two things mostly. Credit scores. What's a good credit score? What's a bad credit score? Let me just tell you this. There's no standard out there that says everybody has to determine that 800 and above is an excellent credit, 700 and above is a very good credit. There's no standard that says each one has to. And financial institutions may fluctuate, say, 20 points. One may say, and they may fluctuate a little bit more than that, but one may say, well, 700 to 750 is a very good credit score, and 750 and above is an excellent credit score. Another one may say 720 to 780, or 720 to 800 is very good, and 800 and above is excellent. And then it goes on down from there. But the thing to know is that if you have a relationship with a banker or a particular bank that you use for your credits or for your loans, and you're going to buy a car or something, it would do you well to call the bank and ask them ask the banker, so what are your categories as how do you that you determine what score is excellent, what score is very good and fair and poor. What are those categories? Because if you're in the fair category, say this particular institution I'm looking at here says from 580 to a 670 credit score is a good. Well, good is not great. I can tell you. When you get down to, or I'm sorry, they say that that's a fair. They say that it is a fair category. Well, I can tell you that a fair and a poor category, they're both not good. You want to get above the fair into the good into the good category. Uh, when you have a poor credit score, actually you've got a bad credit score. So let's say you have a 650 credit score, and your bank says, well, a 670 and above is a good credit score. Well, maybe you want to put off buying a car for a few months and work on moving your credit score up. Pay off some of the balances you have. Let some of the time between the delinquencies you've had in the past and now, the length of time between how long ago you had that delinquency and now, makes a difference. It improves a little bit each month. So maybe you want to work on your credit score and try to get it up to that next level to where it's at least a good. It'll do two things. It'll make it easier for you to get a loan, and it'll make it, it'll get you a better interest rate, so it'll save you some money. Let's look at the last few questions. What's the difference in a soft pull and a hard pull? Anytime you go out there and pull your credit on one of these websites that'll pull it for you for free, that doesn't hurt you. People say, well, don't keep checking your credit, it'll hurt you. No, it doesn't hurt for you to pull your credit report and your credit score. In fact, the banks that you and the credit card companies that you have balances with already, they pull your credit report every month. It's considered a soft pull. It's not for an application. It's just to verify the information is still the same. When you go to lease an apartment, they may pull your credit report. It's okay. It's a soft pull. It's not hurting you. But the hard pulls or the hard inquiries are the ones that if you have a lot of them in a short period of time, it could lower your credit score just a little. It's not going to make that big a difference, but it will lower it some. And that is if you're actually filling out an application and allowing a company to apply for to process your loan application. Used to be that if you went to 3 or 4 different car dealerships in the same day or same weekend trying to find the right car, and they all pulled your loan application, processed the loan application for you. It used to be that would ding you and lower your credit score. Now they calculate that as the same type of credit being applied for over a very short period of time means that you're probably out there shopping for a car and you're not out there buying 4 different cars. So they took some logic and applied it to the FICO score. Should I close unusual? Okay, we talked about that. Which types of credit should I have? Oddly enough, if you don't have a credit card, financial institutions now consider you as a little bit higher risk, because everybody has a credit card, and you need a credit card to do things. Even just to rent a car now, you have to have a credit card, or to stay at a hotel. Some hotels you have to have a credit card to put down. So you need a credit card. I would just say that it just looks at they look at how many you have, how long have you, over what time did you open all these credit cards and department store cards? What's the balance on them versus what you can borrow against them? You know, what is your available balance? And that's about it today. We can get into eventually we may come back and talk about getting a home loan and what all is involved in that, and some things that would help you before you ever go to talk to a bank or a mortgage company about a home loan. We'll discuss that. One thing last thing I would tell you, and this is, unfortunately, I'm a banker. I work for banks. I hate to say this, but lately the credit unions with car loans, if you're looking for an automobile loan, the credit unions are so competitive with their rates. It may be wise to check your credit union. I would certainly check around. I would know what I can borrow before I went to a car dealership. I'd know a little bit about my credit and my credit report. Um, you know, unless you're buying a new car and you know you have excellent credit and you can get the zero interest rate or something like that that they're advertising, get approved for a loan before you go. It'll help you with your negotiations. And one last thing about a car dealership: don't go once you have chosen the car, you've negotiated the price, and all that's left to do is finance. It shouldn't take 10 to 15 minutes for the finance manager to give you a yes or no and what the rate is. Do not play their game of sitting there for 4 hours while they sit in the back room and twiddle their thumbs and laugh about you sitting out there just to keep you. It's a game they play, I'm telling you, to keep you interested and to you're out there. Well, I wonder if they're having trouble getting me a loan. I wonder, you know, because the more you think that they're doing you a favor, the more you think that they're trying to get you a loan that you can't typically get, the more they can get you, the more they will find you a loan that has a higher interest rate, and they're going to take a cut of that interest rate. It's a game they play. When you've come down to the point that you fill out the loan application, you know how much you're putting down, you know how much the car is going to cost, and they send it back to get approved. If they're not back in 15 minutes, tell them, say, look, call me when you get an answer. I'm not sitting here. And they'll do everything they can to keep you there, I promise you. But you, there's no need playing their games. Don't sit there all day waiting on a finance manager to get you a loan. He can get you a loan in 10 minutes. You know, it doesn't take any time. Well, I hope I've helped someone out there, and you know, we can talk a little bit further. You can send me some questions on, well, how do I start establishing my credit? Maybe you're a young person out there and you need to get started. What's the best way to get started getting my credit established? Send me some questions, and I'll do my best to help you and answer them. I'm not giving you financial advice. I'm just giving you my opinion. So, well, I hope you've enjoyed it, and my brother will be back next week, and we'll continue on. So, from Common Sense Cafe, I'm Kevin.